Hello, everybody, and welcome to today's Munch and Learn. I think most of you watching this will be watching a recorded version, so you can pause and watch it again if you want. Obviously, you're not going to be able to ask questions with it being a recorded one, but if you do have any questions, then please contact myself or our guest Danielle directly, and we'll happily answer for you. So let's just kick off. So today's Munch and Learn is all about selling a business. What are the things you need to know when you are selling your business? So I'm delighted to have Danielle Slater with me from Leicester Aldridge, as this is her area of expertise. So before we sort of go into that, Danielle, would you like to sort of introduce yourself and a bit about your background?
Yeah, sure. So I'm an associate solicitor at Leicester Aldridge, which is a full-service law firm with offices in Bournemouth, Southampton and London. So I work in the corporate and commercial team. I generally help business owners and companies, small to medium-sized businesses, with their business endeavours. So that includes corporate transactions, so the buying and selling of assets and shares in companies, corporate governance, shareholders agreements, that sort of thing. And then on the commercial side, reviewing contracts, so customer and supplier agreements.
That's great. Excellent. Thank you, Danielle. And just a bit about myself. I'm one of the 10 coaches that are part of the NoLimits membership community that we've launched. And this is a passion for me, this session, because I've owned 5 businesses in my lifetime. I still own 2, but I've sold 3 during the years. So, so I don't only, talk through in terms of coaching and helping business owners sell their business, but I walk the talk as well, having been there and done that and sold a number of businesses over time. So I'm going to kick off with an opening question for you then, Danielle. So you touched on it a little bit earlier there about shares and assets. So sort of the structure of selling a business, is it better to sell shares? Is it better to sell assets? What's the important parts around structuring the sale of your business?
Well, the important part is really considering the options. So as you say, the 2 options are selling shares or selling the assets. And in terms of preparation for those, the importance that you place on certain aspects of the business will shift depending on the structure. So for example, if it's going to be a share sale, the buyer is going to be interested in the corporate documents and the title to those shares, because that's the most important thing, making sure that they obtain what they are paying their money for, which is the shares in the business. So you might want to focus on the statutory books, for example, which are definitive of share ownership. There are obviously the filings at Companies House, which sometimes mirror the statutory books. They have similar information in, but they don't always marry up. They don't always have the same information. There's sometimes errors. So it's very important to make sure that the statutory books are correct, because those are the definitive title document. And then, so that's a share sale. On an asset sale, the importance then shifts away from shares and shifts to the assets. So for example, if the value in the business is in the contracts, that's going to be the focus of the review, and the company itself and the third party, either the customer or the supplier, is going to be a party to that contract, and the buyer isn't a party. So, but the buyer will obviously want to benefit from that contract as part of the post-completion. So the importance is going to be around reviewing those contracts, making sure they're signed, checking the transferability of the contract. So some of them will have restrictions on transfer and might need consents. Some of them might give the third party the right to terminate the contract if there's a change of control, i.e. a new owner then running the business. So it's those sort of things that might be the focus on each different structure.
Great, thanks, Danielle. Can I just clarify something you said earlier? Statutory books. Just clarify what you mean by statutory books.
Yes, good question. So I've assumed some knowledge there. So the statutory books essentially contain information about the business, and they should be historic. So all the way from incorporation to present day, it should show any movements in shares, so share transfers, allotments, share buybacks and cancellations, details about the directors, and also details about borrowings that have security. So charges and mortgages would also be listed in the registers.
Okay. And which is better, a share sale or an asset sale? If you're selling your business, how do you determine which route to go?
So it's often a tax-driven question. So there are different tax implications. There's sometimes reliefs that are available. So, and it's also the personal preference as well. So for example, if you only have part of the business and you want to carry on running part of the business, you'll do an asset sale and you'll obviously just divest yourself of that particular part that you're wanting to sell, and you'll keep the shares in the company and you'll carry on running the other part of the business that you don't sell. So it really depends on the circumstances and what you're looking to achieve.
And does it matter what type of business? You know, if you're a retail business, if you're a professional services business, if you've got IP, does one lend itself more to asset sale versus share sale?
Not in my experience. I mean, sometimes you might, for example, if you do have IP and it's all registered in the company and you want to, or you have a lot of assets like the contracts, etc., they're all registered in the business, and then it's going to be quite difficult to unravel all of that and get the consents and everything to transfer everything over. Then a share sale is useful in that respect because everything transfers with the company. So the company is now owned by someone else, but the company still owns all of its assets. So you take everything in the business as part of the share sale.
Okay, great. Excellent. Thanks, Danielle. Moving on, a number of businesses I've worked with over the years, you know, it's all about trying to save costs. And, you know, some are a bit reluctant on sort of due diligence and not doing the full due diligence. So what would you recommend needs to be done in regards to due diligence in terms of breadth, what's involved in that, and why? You know, what's the advantages of doing the due diligence?
Yeah, so when you're preparing for a sale, you can do what's called vendor due diligence, which is essentially an information gathering exercise. You'll pull together details about the business, and we normally would present them in a virtual data room in organized folders. And so vendor due diligence, essentially vendor is seller. So it would be carried out by the seller prior to going to market, or at least maybe while you're preparing to go to market. And the useful thing about it is that you can identify any potential issues and you can put in place rectification measures. And that this is prior to finding a buyer. So you can obviously identify those things before a buyer's seen them, and then you don't have the issues with a buyer potentially getting worried about that particular issue and perhaps chipping the price or something like that. And when I say issues, it doesn't necessarily have to be a huge thing. It could be, for example, a contract's been scanned into the data room and you only have every other page because it's it's printed double-sided and it's only been scanned on one side. So that's a really easily rectifiable issue. Or it could be something more serious, like you don't have a signed contract with your major customer that's, you know, 40% of the revenue or something like that, and you don't know which terms and conditions apply to that major contract, something like that. But the advantage is that you can rectify those things before they become problematic in the transaction process. And you also have the advantage of it reducing the buyer due diligence process, which is normally quite a lengthy and it can be costly, that process. So if you have a detailed organized data room already, you can present the business to the buyer, they can review the information in there and only raise a smaller number of inquiries on areas they're interested in or places where they want some additional information, rather than having a full due diligence questionnaire come over at the beginning and trying to run the business and do the questionnaire responses at the same time. So it's useful in that respect to be organized. And you also present a valuable asset to the buyer, and you present a well-organized business as well.
I mean, that's an interesting one. So what you're saying there is if you've done proper due diligence, so if you're selling your business and you've got all the documentation, that increases ideally the value of the business that you can ask.
Yeah, I mean, arguably, yeah, the saleability, the value, the it will become more appealing to the buyer if you can demonstrate that you've obviously got everything all lined up and ready to go, and
Yeah.
the information's there.
So as a business owner looking to sell, then what should be the top things that you would need to provide the buyer when you're looking to support them in terms of the due diligence? What are the critical must-haves in terms of documentation and information?
Well, you'd want to have all of your information about the shareholders, the shares, the directors, all those standard corporate documents. You'll normally have a section on accounts. If you've got financial due diligence going alongside, you might have the budgets and forecasts in there as well. Contracts is a big one, and details about the employees, employee contracts, IT systems. If it's depending on the type of business, if it's a financial business, for example, you might have a regulatory section on FCA or accreditations, things like that, permits. Those are the main things.
Great, thanks, Danielle. I mean, one of the things I work with, as I mentioned earlier, with clients in terms of selling their business is helping them to value their business at the moment. And then there's a particular tool that we use in Action Coach that will then identify what the potential value of your business is so that we can maximize the value. And so what I do is I go through that questionnaire and worksheet with them. And as I say, we identify the valuation now and what it can be at a certain stage in the future, based on there's 8 key levers that we use to really identify the value for a business. And that way a business owner knows what the business is worth now and what it'll be worth in the future. And then we can work and coach them with a plan to actually get to that valuation that they want. Because ultimately, you know, the business needs to give the owner the life that they want. And when they sell the business, the cash that they want to go off and, you know, live in Barbados or buy a boat or whatever it may be. So, but part of that process as well is sort of, you know, during that period when I'm working with them is starting to market the business, helping them find buyers, etc. I mean, from your experience of working with business owners who are selling their business, I mean, what sort of marketing strategies have you seen business owners use successfully?
Yeah, so marketing is an important one to think about at the outset when you're planning a sale. So it's important to ask yourself, what is it that you're trying to achieve from the sale, and who might your ideal buyer be? So I think most people might say, you know, what am I trying to achieve? Obviously, I want a big pile of money out of this, which fair enough. Yeah, you want to maximize the amount that you're going to receive for your shares, fine. But there's the other side of the spectrum is you might have a founder who's built their business up from the ground. They have the reputation and goodwill, and they want to find a buyer who's willing to take that forward and carry on what they've built, perhaps someone who's got the same values as them, which may not be the person who's got the biggest offer, the highest offer. It's you know, something that's to carry on a legacy rather than about the money. You might want someone who wants a quick sale. They found another investment and the window for jumping on that investment's closing, so they just want someone who's, you know, got the cash and ready to go. You might have someone who is willing to stay in the business, so they're not wanting to retire. They're happy to maybe stay on as a consultant, in which case that opens up the door to private equity investors. So sometimes they don't have the management team ready to, you know, place into your business and carry it on, so they need the management team to stay in situ and essentially run the business for them. So yeah, once you figure out what you're trying to achieve, that also then paves the way for your target buyer and establishing who you would want to market the business to. So once you establish those things, you can then perhaps instruct a corporate finance advisor who can market the business accordingly. They'll be able to target the buyers, and having that knowledge of who you're looking to market towards might be then improve the finding of a buyer. You might find one more quickly, and you can also advertise accordingly. So if there's a particular aspect of the business that's going to appeal more to this specific target buyer, that will be then accentuated in the marketing materials.
In your experience, do you deal with much on the private equity side? Is that a growing area? Do you see much happening in terms of trends in the market?
Yeah, we do. There's well, we found that there's been some potential issues with funding. So if trade buyers are having difficulty obtaining funding, then the private equity investors are the better option there if they've already got the funds and they're ready to go. But you'd have to find the right private equity investor. If the seller is looking to retire, for example, you'd need to find one who has expertise in the business already, so that they're ready to go and that the seller can achieve what they want to achieve, which is an exit from the business.
Mm-hmm. Yeah, it's interesting. I've got a background in fund administration in London and in the Middle East, so dealing with private equity is something I've dealt with a lot over the years. So it's quite a fascinating world when you're dealing with some of the big PE firms and when they're trying to sort of build out along a particular, industry, etc. But it just sort of, when you were talking there earlier, it prompted me on one of the challenges that I find, which, as you say, private equity can help with, is when the business is the owner, where everything goes through the business owner. And effectively, if the business owner sells the business, then on Monday, the business owner is not there is no business to sell. So it's a key area I work on with clients to make sure they've got a team of people that can run the business when they walk out on Friday evening. If it isn't, then obviously private equity can come in, because quite often they bring in their own management team, obviously depending on the size of the business.
Yeah.
So just moving on, picking up on one thing, you talked about advisors earlier. Obviously, a legal advisor, in your point of view, obviously a coach is needed as well. What other advisors would you recommend a seller would look to engage with to, make this a successful process in selling their business?
Yeah, so I'm obviously a legal advisor, so I advise on the legal aspects of the deal, but there are also sort of tax and financial aspects as well, accounts, which I can't advise on. So I would normally work collaboratively with the other advisors of my clients in those circumstances. And it's useful to have those other advisors involved because it helps the process run more efficiently. For example, if you come up to a tax point in the agreement that I can't advise on, we then have to look to the other advisors to provide that advice, look at that particular wording, and perhaps provide some amendments or some detail. But if we're not already in contact with that particular advisor, we'd have to go through the client, and then they perhaps get the information and give it back to us, and it just sort of extends the whole process. But that would be sort of later down the line. In terms of preparing for a sale, again, it's useful to have everyone on board early, particularly for preparation of heads of terms, which essentially would set out the main headline terms of the deal, normally the highly negotiated points, so that you can get those agreed at the outset, and then they can then be reflected in the agreement, and it reduces the negotiations going forward. But if you have a holistic input into that document, it will make it much easier going forward and make sure that it has the necessary points in it from each aspect.
Okay. Danielle, we've covered quite a few things as we've gone through the last sort of 20 minutes or so. I mean, what is the sort of process? I like process, A, B, C, D, E, know where I'm going, get to the end, etc. So when you look at it, obviously somebody will come to you, and the starting point, I guess, at the end of the day is, get the heads of terms drafted. That's probably the starting point. How does the process work from there?
So from the heads of terms, you obviously, you've got a buyer at that point. You will have already had an NDA in place. They've probably seen the information, the information memorandum potentially prepared by a corporate finance advisor. So you're there, you're at heads of terms, you've agreed the headline terms, and then if the buyer and seller haven't already instructed advisors to deal with the heads of terms, sometimes they'll deal with that aspect on their own, although it's much better to have advisors involved so that you make sure that you do cover off the necessary points. the next step's going to be preparation of the relevant document. So it's either going to be a share purchase agreement or an asset purchase agreement, depending on the structure. And that would be prepared by the buyer's solicitor and reviewed by the seller's solicitor, which I think is the opposite in property transactions. And yeah, so that agreement will essentially set out what's been agreed in principle in heads of terms, and it would normally have warranties in there about the business, so essentially statements about the business, and as well that will set out the consideration. So if it's going to be cash, if there's going to be an earn out, for example, which is where some of the consideration is held back and it's paid depending on the way the business might perform in the next year or two, something like that. And another document that sometimes goes alongside the main agreement is what's called a disclosure letter, and that's for the seller to prepare. And it's essentially disclosing things about the business that are not quite in keeping with the warranties. So if the warranty says one thing about the business and that's not quite right, the fact is that it's something a little bit different to that. So one of the examples is that there's no litigation, something like that. There's no disputes, but you actually do have some issue with one of your customers not paying or something. They're not happy with some of the services, so they're refusing to pay or saying that they should pay. You would want to disclose against that warranty that fact that you do have that dispute with your customer.
Okay.
Yeah, so that's the main agreement, and then you obviously have ancillary documents to go with that, board minutes to approve, director resignation letters, things like that.
Mm. A question I often get asked is, when is it all sort of legally binding? Obviously, heads of terms is not legally binding.
There are parts of the heads of terms that could be legally binding. You specify which parts. There's normally, confidentiality provisions in there. You might couple it with exclusivity, so that you promise not to market to another potential buyer during a specific period of time. But yeah, generally the deal terms are non-binding, and we normally do simultaneous exchanges and completions on share purchases, but it doesn't necessarily have to be like that. For example, in financial companies, if they have FCA regulation, the new buyer will have to then get their authorization in place. So we'll have a period between exchange and completion where they might satisfy some conditions, and then once they're satisfied within that period, within maybe 5 business days, something like that, then completion will happen. And once you've completed, that's when the deal is done. The shares will transfer on the completion date.
Okay, great. And just looking at trends in the market again at the moment, Danielle, are you seeing a lot of cash sales, earn out deals, share deals? Is the market moving in any particular way at the moment?
I think it normally depends on the buyer, really. It's a negotiated point, so it's whether they have the cash ready to go, whether they want to hold some back if they're not sure about how the business is going to perform. It's normally a negotiated point, so it's not necessarily a trend that I've seen. It's more so the parties that are involved and what their negotiating position, because obviously the best position for a seller is to receive their cash on completion, and then they're happy, they've got what they wanted for their shares. But best case scenario for a buyer would be to pay less upfront, see how the business is going to perform, and then perhaps pay some deferred consideration later.
Mm-hmm. Okay, we've got sort of 3 or 4 minutes left, Danielle. So just again, from a business owner's point of view, who may be listening to this and thinking of selling their business in the next few months or few years, etc., what are the biggest challenges that they need to be aware of and prepare for?
I think the biggest challenges that we find is just getting so normally they're running the business alongside getting everything ready for sale, and it's a big job to collate all of the due diligence information whilst also running the business, and then also making sure that they're not sort of casting the net too wide in terms of their helpers within the business, because if the word gets out that they're selling, for example, that could have a detrimental impact on the business. The staff can get a little concerned about their job security, things like that. They might start looking for other jobs, you know. So there's a lot of things that come into play when you're preparing for the business. Mostly getting the information together, the due diligence information, whilst running the business alongside. And there might be a well-run business, you've got all of your documents together, you've got your statutory books together, but more often than not, we find that the business has been running fantastically well. That's why they're coming to sell, but they've perhaps not got the corporate records that they ought to have in line. So there's some work to be done there to bring those in line, like the statutory books, for example, which can be quite a time-consuming process for a company that's been incorporated in like the 70s, for example.
And when people come to you, Danielle, do they come to you sort of at fairly early stages without having all that documentation, and you've got to sort of guide them, or are they generally pretty well prepared?
Yeah, I mean, it's both, to be honest. We've got clients who we act for. We've been advising on their trading contracts on an ongoing basis, and they get to a stage where the business is valuable and they're ready to sell, in which case we've been advising them all the way along, so all of their corporate documents should be in line and ready to go. And then we have other clients who've come to us, they're already ready to go with their heads of terms, for example. We haven't been involved in their business before, they just would like us to act and advise them on the transaction, in which case we might have to take a look into that as we go, because they're obviously already ready to go with the buyer. So we help them with the due diligence process, and we have to juggle the two, the transaction and then pulling together all their corporate documents.
That's great. Thanks very much, Danielle. So just to sort of wrap up then, if you're watching this and you're considering selling your business, please reach out to your local coach, your local action coach, because we'll certainly be able to help you in terms of valuing your business now and in the future, and work with you and coach you to implement a plan to maximize the value in your business. And similarly, you know, if you're looking for legal advice, please reach out to Danielle. I'm sure she'll be able to help. Absolutely, no doubt she will do. So Danielle, I'm going to leave you with the last word. What sort of takeaway should people have, having listened to this? What's sort of the top 1-2 things that they should do in prepping for a sale?
Top thing is just to be organized and to make sure that you get your advisors on board early, so that you can make sure that you have the necessary protections that you need early on. And that's it, really.
Great, excellent. Well, thanks, Danielle. Thanks for your time, for joining us. And for those of you who are watching it live and watching a recorded version, thank you very much. And as I said at the beginning, any questions that you've got, please reach out to myself or your local action coach, and to Danielle as well, and we'll be happy to help. So thanks very much, everybody, and have a good day. Thank you very much, Danielle.
Thanks.
Okay, bye.
Bye.